All right, guys, we are going to get started. My name is David Garfunkel. This is Andrew Jones. We both work at Index Cooperative. I'm head of DeFi partnerships, so we've both been around for about 3 years since Index Co-op started. We're going to talk about risk management today. Not the sexiest topic, but incredibly important. I wish there were more talks like this at ECC or in general. We go to a lot of conferences. Most of these people shilling their products. We're not going to do that today. We're going to talk about how we build our products, talk about the protocols we build on top of. Thankfully, we have some of our coworkers here. They know how we build our products. If you have any questions, let us know. But yeah, we're going to get after it. You can find me at funkmasterflex.eth. Most people know me in the crypto ecosystem as funkmasterflex. But yeah, I work on DeFi partnerships. That's everything from wallet integrations, custodians, building on top of other protocols, things like that. Used to work in TradFi and equity capital markets, built renewable energy power structures and things like that before I came here. And now I work doing fun DeFi stuff.
Cool, yeah. My name's Andrew, and my pseudonym on Twitter is Mr. Medilla. Yeah, I work on the product design side at Index Coop, and my previous history was in TradFi for about 10 years, working in investment banking, custodial banking, and asset management.
So Index Cooperative, Index Co-op, Index Coop, as many of us say, it started about 3 years ago, which is old in DeFi terms. We're a DAO. That can mean a lot of different things, but we vote with our token. We vote to launch different products. We started in 2020, at the end of 2020 in October, with the DeFi Pulse Index, DPI. You guys may know it. It's one of our biggest products. It was our first product. In my opinion, it was like one of the first DeFi money Legos, one of the first ways to build on top of the crypto ecosystem. Our goal and mission and strategy and focus is simplifying access to risk and returns. We call this the new financial system, internet financial system, DeFi, crypto. For us, like, it's super complex. Like, there's so many things to do. There's so many things and protocols within crypto. For us, like, we want to make that easy for users to get into. And users could be not necessarily people in this room, but users are people walking into Coinbase wallet, have no idea what to do. So we hope to make that a little simpler. So like I said, we launched DPI in 2020. Crypto in 2020, DeFi in 2020 was a bit different. Aave was still called ETH Lend. There's no Uniswap token. Really, there wasn't much to do in DeFi. You could lend on Compound. There were a few assets. It was mainly just ETH and a couple stables. But we started at a point where it was like, how do we make this a little simpler? How do we make this a little safer, more particularly for users? And that was what we tried to get at. So DPI has been around for 3 years. We rebalance it every quarter. But the main goal back then was, let's make it a little easier. And as I said, I think of it as the first money Lego. Money Lego is like a term a lot of people in DeFi use. I think it's used incorrectly pretty often. But yeah, we build on top of all these DeFi money Legos. So for DPI, an example, just one little token on top of all those. An important thing that I think we get lost in is like, why are we building these things in DeFi? To me, like, and to Andrew, like, both of us coming from a traditional finance background, like, it was relatively obvious why we needed some of these things. It's relatively opaque, the traditional finance world. Like, to us, it's super important that things are on chain. Things are most of the time permissionless, sometimes not. But it was important that this like new financial system we're building is one, all about ownership and self-custody. To us, like, if you're not actually holding your keys to your crypto, you obviously don't own it. I think we've seen that with CeFi in the past year or so. It's been super disappointing for us working in DeFi to get compared to FTX and possibly Luna and others and these CeFi yield services. For us, it's incredibly important that when you say you're getting 5-6% yield on whatever asset, like, it's actually there. It's not just made up, because that's really what it was in the past couple of years. It was made up yields. And to us, that's incredibly risky. The opaqueness of that is very harmful to the actual industry. So for us, like, when we talk about some of these products, like, you can check on chain. Like, you shouldn't trust us when we say our products are great or anything like that. Check chain, see what you think about the products. You always know you're going to own it, most importantly. So obviously, we're in France. Are we building the future of France? I honestly don't think so thus far. As you can see there's quite a bit of money that's lost seemingly every couple of weeks. There was a hack a couple of weeks with Sturdy Finance. We like the Sturdy Finance team, but they're just things that need to be safer. As I said, like we worked in traditional finance like 3-4 years ago, we'd get laughed out of the room talking about Bitcoin and Ethereum. Now it's a different story, but it's still the same question. Like, how is it that $200 million are lost seemingly every couple weeks? That's a big concern. And if we're not thinking about risk management first, if we're not thinking about how these products are safer for the end user, whether it's an institution or someone using CFI or a retail customer, if we're not making it safer for those people all the way across the board, then we shouldn't be doing this. So at Index Cooperative, like it's incredibly important for us that we start at that risk management layer and try to build something that's actually a bit safer. A few of these on this list, like we like as users of DeFi, like even Compound's on there. Wintermute's an investor in us. I don't want to call them out, but people make mistakes, and if we don't rectify some of these issues, it's going to be a major problem as we try to get into institutional finance. I think a lot of people in DeFi say they have institutions coming, and it's certainly just a lie. Like it's not true. If we did, the prices would be a lot different. So I think when that time does come, if we're not ready, if we don't have 30-page risk reports, we're not gonna get that capital. I don't know about you, Andrew, but like you probably had risk reports you had to read for days and days when you were in your old job.
Yeah, certainly. So one of the departments that I worked in was stock loan, and so one of the biggest risks there was counterparty risk. Particularly when kind of Lehman's went under, there was a big scramble to find out, how much collateral was on loan to Lehman's. So risk management in TradFi got turned up to 11 after the Lehman's moment. Previously, it had been on 2. And so, there was a massive kind of cultural shift, and risk management became like a massive thing in TradFi as well to manage that counterparty risk. Lots of reporting and new metrics came online, and entire departments were spun up, even kind of inside other departments, new risk departments were spun up then. It became a big thing.
Yeah, I was 10 years old in 2008 when the banks crashed. So for me, it was like starting at a point where, like regardless of how old you may be, like crypto's an incredibly new system, and you can. I went to Princeton University, like I studied economics and finance there. It's like they don't teach you like what actually went wrong in many of those cases, and I think crypto takes a clear look at like what some of these things are and what we need to fix. Like we go by Mr. Medilla and Funkmaster Flex, but that doesn't mean we don't care about these important key issues in risk management, and to us they're incredibly important. But yeah, like I said, I was 10 years old and people didn't tell us what happened. I had to figure out for myself. I had to go to college and figure out how to do these things. But for us, like what we do is on chain and it's proven. So if we don't put out a 30-page risk report, like you can see on chain what we're getting into and how decentralized the protocol is, and for us it's incredibly important as we build on top of these protocols that we know each and every piece of what we're building on top of. So we're hopefully going to go over some of those things today. This is not a beautiful presentation. Our design team is standing right in front of me. So I won't say it's beautiful or perfect. This is a curve you see often, like crossing the chasm, try to get into this majority and late majority and get into this like real world of people. We're certainly in this innovator area. People would say we're in the early adopter area. Unlikely. I still think we're very much on this left side of the curve. People talk about this as like an adoption thing. To me, it's very much about risk. As I said, I work in DeFi partnerships. Like when we talk to institutional teams, like they're so far away from this that like they need to understand why this is safer, why this is better. It's not to them like, okay, I love ETH as an asset. Like that doesn't matter to them. They care about if they're gonna lose all their money and they care about if they're gonna lose their business. So to them, risk is certainly more important And I think as we talk about like the new billion users into crypto, into Web3, if we don't think about their risk profile and how they think about crypto, we're certainly going to be at a loss, because we can talk about crypto with people in this room, but if you go ask your friends after this, or you go home for Christmas or Thanksgiving, like you say crypto and people like automatically get a little scared. And if we're not able to talk about why this is possibly safer, if we're not able to talk about a 30-page risk report, they're always going to be scared about these things. And as someone who works on like the growth side of Index Cooperative, if we don't like build that trust, we're never going to get these next billion users, or whatever we want to say. So some goals of this talk, like generally some goals of like risk management and DeFi. We really need to standardize some of these things. So there's a lot of different risk management practices. There's a lot of different teams that work on risk management. We're going to have someone from Gauntlet here later on. Paul's in the crowd already. But there's so many different standards, and like if you look at a S&P or Moody's, like there's no, it's not subjective. They say this is the risk score, this is what it is. Even with DeFi yield, like Andrew looks at millions of LP positions, it's even hard to calculate where these yields are coming from, if it's even true. So for me, like I've been saying this for the 3 years I've worked in Index Cooperative, like if we don't come up with standard risk practices, we're just gonna have a hard time. Standard risk practices are different from standard scoring systems. So like I said, if we have S&P and Moody coming on top and saying, okay, this is the risk rating, this is the credit rating, we're going to give this protocol or whatever it may be, certainly helps us. There was actually a protocol or a team that came out over the weekend. I'm going to forget the name. Blue Chip. Yeah, we try to sell blue chips. It's a rating agency for stablecoins. To me, that's incredibly important. That like shows so much maturity in this space. It's something we haven't had in the past couple of years. It's something we certainly need. We hope there's more of them. I know Andrew is super excited about that. We try to build diversified products that use all these different stablecoins, and we just haven't been at a point where we know what's less risky or more risky. So I'm about to show a slide that may be controversial. To me, it's like a huge turning point in crypto. I was very excited for this to happen. The headline doesn't sound as good as it is. This was incredibly important to me. This is about a year ago. Compound got a B- rating for their Compound Prime. B- is better than some countries. So to me, like, this was a good sign. This was a Bloomberg article, so someone in TradFi probably saw this and went, oh my God, I'm never going to use crypto again. But at least they rated. At least they gave Compound a rating. Like to me, that was incredibly important. I don't know if we'll ever be at the level of AAA rated bonds or anything like that, but this was like an incredibly important turning point for the ecosystem. Hopefully we have more of these. I don't know if you'd ever be able to invest in a B- bond in your past life, but this was incredibly important to me at least.
Yeah, I mean, like there was still plenty of funds in TradFi that will, invest in junk credit, high yield, bond funds are definitely a thing, and ETFs as well.
Yeah, certainly, especially these days. Okay, so these are some categories we think about. Again, this isn't a beautiful presentation, but these are some categories that we think about when it comes to DeFi risk. You guys could certainly shout out a million more risks that come up. We hope that we can bucket some of these risks into these areas. You guys can read that at your own, but we're going to go through each one of these, sort of talk about how we came up with these. So Andrew here and Alan, who's also in the crowd on our team, works on our product team, came up with this risk framework that we use to pick these products to build some of the indices we make. We go through each of these, we sort of build out a risk score for each of them, and then also a relative risk score. Could you talk about a little bit about like the relative versus indicative risk framework?
Yeah, I think just before we get into that, you mentioned like the S&P ratings for certain structured products. I think they're much more easy to put quantitative measures against those. They don't have to deal with a lot of the risks that we're seeing up here, like smart contract risk, hack risk, stuff like that. So really they can give quantitative scores based off of volatility and things like that. Whereas in DeFi, we're not really at that stage yet. It's still, there's some obviously quantitative measures that you can put in, but there's at the moment as well, we have to rely on some qualitative metrics as well, which some of these definitely are.
Certainly, and because of that, some of these risk frameworks and risk scores will be a bit subjective. You may disagree with some of these. There are other ratings agencies that may have different scores. But yeah, this is what we think of. We're going to bring Paul on in a bit to talk about how Gauntlet thinks about risk. But yeah, let's start with asset risk. Very broad, refers to the quality of an asset. This is how we think about it. What I have on screen is the DAI backing. This was last week. If we wanted to get a live version, you certainly could. I think it's DAIsupply.com. This is all on chain. So when we go to a protocol, and this is a concern of mine when we talk to someone we're trying to partner with, if they don't have these stats like live or they don't have a dashboard that's ready to go, that's a huge red flag in my opinion. Like if this stuff isn't readily accessible, like it means maybe they're hiding something, or if not, they're just being complacent. So so when we talk about, on this screen, we're talking about stable coins here, but this could be about a staked ETH asset. This could be really about anything. So when we talk about asset risk, you could compare DAI to Frax, you could compare DAI to SUSD, you could compare DAI to Curve USD or Go that just came out yesterday. The collateral backing is like a very specific part of stablecoins. You may look at node count for staked ETH providers, for example. But yeah, asset risk is probably the first thing we look at. I don't know if you want to talk about any specifics there, but when we think about asset risk, like it's a very broad spectrum and it's very subjective. So like this is the first thing we're looking at, and we may not come up with an exact answer, but it's how we sort of start the conversation.
Yeah, and one of the reasons we really started to talk and think about risk as well is in the early days of the DAO, there are lots of product ideas, and everyone's like very excited about the returns you can get in DeFi, but nobody was really thinking about the risks. So it was like, you know, comparing something that's getting 5% yield versus 10% yield, and nobody was asking, well, is it double the risk? And if it is more than double the risk, then it's not worth it on a risk-adjusted return. And so very quickly we started to think about, okay, because we're in this for the long term, we want to be fairly conservative, especially at the beginning. I think we are fairly conservative, and we want to build sustainable products. And also we manage our own treasury as well, and we do so in a conservative way. And we don't want to lose all that capital, obviously. And so we had to think about that in much the same way we do with our products. So yeah, asset risk was one of the first, one of the first obvious ones. And Funk was just saying there about like going and checking on chain. So for some stable coins, such as DAI, obviously you can go and actually look at the contract and you can see the backing of the collateral for DAI. But it's not just the collateral we're looking at as well. We will also look at the smart contracts to say, okay, you know, is there other risk in there, like, you know, can somebody essentially rug it via multi-sig and things like that. Yeah, we'll probably get onto that in a moment, but a lot of the time we use proxies as well for risk. And so what I mean by that is we will tend to look at what the ecosystem is using to measure risk. And so for protocol risk, we tend to look to company or protocol called DeFi Safety, and it's not quite audit level depth, but they will do like a holistic look at protocols and talk about their audits, their multi-sigs, their governance, things like that. They will give them a score, and we will include that in our asset risk as well for ones that are built on top of protocols.
Yeah, Andrew said risk-adjusted returns. Sadly, that's not said often enough. So protocol risk could be thought of as smart contract risk. It's really anything as you talk about like how this product is built, how it's like automated through smart contracts. Andrew talked about DeFi Safety. There's a couple risk scores that DeFi Safety puts up there. This is not something that every person can go in and say, oh, I'm just going to audit this code. Like, I think that's something that everyone says, oh, it's open source, like you can check. Like you really do have to trust others for this. Like I'm certainly not going to go in and audit any of these smart contracts. But really, like you need the backing of audit teams, you need the backing of smart contract teams and security teams. So for example, like Aave v3 had 6 different smart contract audits, and they probably said that wasn't even enough. They probably wanted to get more, but there probably aren't more than 6 reputable security agencies to actually do this. So to us, that's really important. Like we would never use a product that didn't have multiple audits. We would never launch one of our products that wasn't audited multiple times. On top of this, there's also bug bounties. We can talk about a bit more about that later. But once you do launch a protocol or product, like continually making sure people are coming in and checking that everything's working, it's incredibly important. So as Andrew said, DeFi safety is right here. They have a few different risk levels and risk measures that they look at. It's certainly not the gold standard. I don't know if anyone from DeFi safety is here, but there's certainly much more we can do. This is just one example of a rating agency. I don't know if it's on the level of S&P or Moody's, but it's certainly important. It's certainly something we use. But again, we would never, like if Aave v3 came out a couple months ago and had one smart contract audit, we'd be a bit scared about that and would certainly be reluctant to use it. Andrew, you're also not auditing the smart contracts, but do you think there's like a certain number we should have or anything like that?
No, I'm certainly not an auditor. I mean, as many as possible from reputable names. We know that there are some auditors out there that consistently are being highlighted when protocols get wrecked. And so that kind of anecdotal trust or lack of trust will build over time reputationally. Just out of interest, does anybody here like manage DAO treasuries or anything like that? Hands up for any DAO treasury? No? Okay, cool. Just us. So yeah, I saw someone doing a Morpho t-shirt as well, but I think they've left. But yeah, Morpho are obviously doing well, top of the pile in this list.
Yeah, we like Morpho. Okay, so this may make a bit more sense when we talk about like the strategy. This could be lending versus LPing. This could be just the general like strategy being used underneath. This is from DeFi Llama. Like obviously you look at this and go, okay, this one has a 16,000% APY. That sounds great. Like maybe I should buy this.
I'm in.
Yeah, but that's 2 years ago. If you said that, like people would go, okay, yeah, like maybe they just got a lot of rewards to hand out. But when we talk about risk-adjusted return, you literally shouldn't even put these two things on the same screen. But you know, like there were forks up until a year ago that promised APYs like this, and people went, oh, like maybe that's real. Maybe I have time to get that before it goes away. If you were to show DeFi Llama to an institutional investor, I don't think they'd ever like want to come into the space. I think stuff like this certainly scares people. It's certainly tough to say like even UST with Luna, it's like if you're offering 20% and everyone else is offering 5%, like you're wrong. Like there's no like oh maybe they found some cool new mechanism. It's just that doesn't exist. So if you're not comparing some of these yields to what other platforms are offering, you're in for a lot of trouble because either they're doing something fishy or you're the last one in and you're not going to be able to get out. So this is an example of a staking position on Lido versus some crazy LP position. But these strategy risks can differ from lending to LPing. One thing that's really important to us, and it's the reason we built some of these products, is you could have like a Curve 3 pool that has 3 different stablecoins in it. If one of those stablecoins goes to 0, the whole pool goes to 0. So it's like, you could say like LPing is less risky, but it's not less risky than 3 lending positions or 3 different LP positions. Once you sort of start bundling all these LP positions and everyone can say it's capitally efficient and all this stuff, and oh, we have this new mechanism that makes it so efficient and all this. Most of the time, that's just adding extra risk. So we recently built a money market index on top of Morpho, Aave, and Compound, and notional finance. To us, it's very, very important that the overall value at risk, which we'll talk about in a second, is not 100%. So when it goes too much into an LP position and you say you're diversified into multiple different assets, you're probably not. So we haven't built an LP product at this point. We probably will, but that's one of the reasons. It's a bit scary to us when if one of them goes to zero, it all goes to zero. When you're building diversified products, you certainly can't have that.
Yeah, or you're reliant on kind of emergency governance to step in and freeze the pool. But yeah, when you see like massive kind of yields like this, I think the simplest thing to do is ask yourself, where does the yield come from? And if somebody can't explain it to you in a tweet, then it's probably not legit. That's how I view it anyway.
Yeah, certainly. If they can't explain it in hopefully a sentence, there's probably something wrong. Traditional markets use a 30-day average, SEC 30-day average yield, something we should certainly adopt. It's what Index Coop uses. But if you're to look at like the yield of a product, if you don't look at it over a time horizon, you're not looking at the right thing, because an LP product could have a ton of fees in one day and then have zero fees the next day. So to us, it's super important that you're looking at the average yield over a time span. Most people don't do that. They're probably just advertising their best yield during a time span, which is very, very risky. So economic risk is relatively simple to think about. The biggest way to think about this is just volatility in crypto. So this chart's like pretty silly, but obviously like the Bitcoin price is volatile, USD price is not as volatile. When we think about that in crypto, especially when we use borrowing and lending markets, when you have a borrowing position, and this example was used yesterday on a panel I was on, during like 2020 Black Thursday, ETH price went down like 40% in a day. That doesn't happen in traditional markets. Like there aren't mechanisms to figure out how to de-lever when things go down 40, 50%. But it's something we have to be very cognizant of. Index Coop builds leverage management positions. So we have a ETH 2x leverage position that automatically would de-lever some of these during super volatile markets. To us, that's incredibly important. Like, crypto moves so fast that if you're just to sit there with an Aave position open for, I don't know, a couple weeks and you don't check it every day, unless you're like continually refreshing the page, like it's very unsafe, and it's not something traditional finance experts are used to. So I know Andrew holds many of our LP positions, sort of rebalances them, but you're often like I'm forgetting the word. Repositioning, recentering all of our LP positions, and they can change in an instant. And if you don't have a full team looking at this, you should probably have that automated. And if you're just trying to sit in an Aave position by yourself, or you're sitting in Compound by yourself, you're going to be in for trouble when that day comes when the price goes down 40%, or conversely when the price goes up 40%. You still have to think about like how these things are actually going to move in practice. Okay, so value at risk is an incredibly important one. This is something we think about often. This is like one of the main risk measures that someone like Gauntlet would put together. What I have on screen is the Curve 3 pool, and it's the example I gave of an LP position. If one of the things goes to zero, it all goes to zero. So you could say, all right, I'm in Curve 3 pool, that is DAI, USDC, USDT. It's like if the example here, this was not very long ago, this was a few months ago, like USDT is 73% of this pool. Like, to us, that's one, not diversified, but it's totally out of balance. And you may get a lot of fees during crazy markets like this, but you're certainly at a high risk. And this happens whenever there's a depeg. This happens when there's very, very crazy market conditions. But this happens very often. So if you're not aware that you're now 73% in Tether, a centralized asset, you may want to rethink why you're actually investing in this pool, for example.
Yeah, and the amplification factor on these pools is set by Curve as well, so they can increase them and decrease them, and that can also affect the behavior of the pool, especially around volatile times. But yeah, it's definitely a scary one when you think, if any one of these were to fail, you're going to lose 100% of your capital.
Yeah, so this example here, the value at risk for this LP position is 100%. When we try to build diversified products, we need to know that if one of these pools goes to zero, or one of these stable coins goes to zero, like what's actually going to happen. So like I said, we have a money market index that has compound, notional, AVE, and morpho positions. If one of those goes to zero, like you still have this whole entire portfolio. So for example, like a year ago, if you were 100% UST, like you lose all your money. But if you are in 5 different stable coins, you only lose 20% of your money. So when there's only a couple options in DeFi, like for the past couple years, there's really only been those 3 stable coins. You could say there's others, but on a risk-adjusted return, those are probably the only 3 in the past couple years. You could say you're diversified, but if you're not really diversified in the strategies, if you're not diversified in where these assets are going, you're gonna end up wrecked. Maybe not an exploit like wreck.hq, but it's still tough. You can read this little snippet. I also think it's from a Bloomberg article, but contagion risk is a difficult one to quantify, but you kind of know it when you see it. Like I think when after FTX, everyone was like, okay, where's all the bad debt? It's the same example Andrew gave with Lehman in 2008. It's like, where's all this money going? Who owes who what? This can sort of cascade. So, for example, like after FTX happened, it was like, okay, what happened to Genesis? Oh, you mean Genesis on the back end of Gemini? Okay, well, I have money in Gemini. What do I do? And you kind of have to wait for the pieces to fall. If you're using a real DeFi product, it's not going to be the case. There's no one like custodying these assets. There's no one backing up these specific products. You're not dependent on a market maker. So yeah, this can get bad. There's certainly other examples in this article. They say that FTX was sort of a cascading effect from the contagion of the Luna crash. But this is certainly something that happens in traditional markets, certainly something that's happened in crypto in the past. I think DeFi tries to get away from this as much as we can, but it's certainly still a risk. We talk about these money Legos, and money Legos, while interesting and while taking advantage of all the cool parts of DeFi, you can sort of have this cascading effect if you have money in multiple protocols sort of all relying on each other.
Yeah, one thing that I find quite interesting about this is obviously in the off-chain world, whether it be FTX, whether it be TradFi systems, is it's so opaque. Nobody knows where the risk is concentrated or where this bad debt is concentrated. But yeah, in crypto, you can scroll through your Twitter feed and someone's like, hey, somebody's got a really large, I'm not going to mention the token, but a really large position on Curve, and this is actually getting so large now that this is now a risk to Aave, and then you'd often get Aave kind of take a governance measure to like close that particular market, and that's all thanks to the power of kind of transparent blockchain technology, which I think is really huge. For the first time ever, people are able to publicly audit it, and few people on Twitter just like to do it for fun. But it definitely sends out a big red flag. And this is all part of the kind of evolutionary process of DeFi. And it's why it's happening at such a fast pace. Because people are, like have that self-interest to go and monitor it and alert people to it.
And you can audit things in real time. It's not a monthly, quarterly capital call where you go, oh, okay, maybe all my money's actually gone because they finally did a capital call at the end of the quarter. It's like, no. You need to look now. You need to look how things are going to be tomorrow, not a quarter from now. We all like feel this example, but it's super important to understand like what's going to be the next example of this, and like you have to know where your funds are and where everything is on the back end if you actually want to be away from this risk. So cooperative risk, this is probably the most unique one to crypto. If you were to ask S&P, they'd probably say this is why Compound got a junk bond rating, just because they don't understand the mechanisms of governance. I don't think many of us understand the mechanisms of governance, to be honest. But really this comes down to like, are you dependent on others to make sure your protocol runs correctly? There's governance in DeFi. There's some governance that's on-chain. There's some governance that's off-chain. If you're relying on others to perform the final function, if you're relying on a specific person to maybe liquidate your assets rather than the protocol doing it, you can be in trouble. We like Aragon. Aragon's a good project, but people took over their treasury basically, and they had to come in and manually sort of like restart. That's super concerning. There are other examples of this. I won't highlight a bunch of them, but governance attacks are like part of the reason like people really don't understand crypto, in my opinion. I don't think we've really been at a point yet where like major money comes in, buys up half the supply of a token, and then performs a governance attack. That might have been what Citadel did to Luna. Who knows? But like it's certainly a risk that like we haven't seen come to full fruition yet, and it's a scary one in my opinion. Luckily, no one's selling our index token to one individual, but it could be relatively easy to sort of go under the radar, buy a bunch of these tokens, and do whatever you want. Aragon's an example of this that I put up just because it happened recently. But yeah, governance risk is relatively scary. Lots of teams use like compounds, like open source governance framework for on-chain voting. I'd recommend something like that, but even then, like if you have a large percentage of tokens, you can kind of do whatever we want. So we built this like framework where users own these systems, but if users own these systems and they're bad actors, it sort of heightens the potential risk of these things. So to me, this is a scary one. To me, this is why Compound was given that junk bond rating by S&P. And it's really one of those things like we need to be more transparent about how our governance systems work. Index Coop is not fully on chain with every single vote, so there are some risks there, and we understand that, and we're trying to fix them, but it can't be the mentality of, oh, we'll decentralize later. If there's not a roadmap for many of these protocols to fully decentralize, they need to think of one now, and if not, your users are at risk. So.
Yeah, and I guess just to give an example of a protocol that's completely the opposite of ones that are dependent on governance, one would be Liquidity. Big fans of Liquidity. Yeah, their protocol, their V1 protocol, is immutatable. So there's no risk of governance attack. So that's one example of a really safe, quote unquote safe protocol.
I totally agree, and that's why Liquidity has a 97% score on DeFi safety, because there's no vector of governance attack. I can pull up DeFi safety live after this, but Liquidity is a great example. If you're worried about those risks in a stablecoin, maybe that's the right one for you. If you're worried about adding bad assets on top of a stablecoin backing, that might be the right one for you. But yeah, I'm glad you brought up that example. There's a few other like governance risk teams that I guess are working to try to make this world more decentralized. What I would say is you have to be moving to an on-chain governance system, and if you're not, you're probably going to be left behind. Most of the protocols we work with are on top of. Most of what they do is on-chain governance. They have some things that are off-chain. Uniswap's a good example of this, though. Uniswap has like snapshot voting, which is off-chain, but when Uniswap v3 launches, like no one's changing it. So that code is like set in stone. That's like incredibly good in my opinion, because it gets rid of the risk of someone coming in and saying, oh, I know how to rebuild Uniswap v3. It's like, well, if you know how to rebuild Uniswap v3, build it in Uniswap v4. And then if you want to fix it again, build it in Uniswap v5. So that's really important. Like immutable code is really important. If you're in a DAO and you decide, hey, I want to completely change how this product works, that's very risky. And if users don't know that, they're probably going to be left in the dust. So I talked a bit about bug bounty programs. Andrew talked a bit about just like the legitimacy of some of these smart contract auditors. Won't name any names, but there's like a meme that I love. I probably should have put it on here. It's like guys like checking with a wand, and it's just like eyes are closed, like not even checking anything. You could pay $100,000 for a smart contract audit, and they say, oh, it's perfect, we found nothing. There are other ways to do it. What's the one where they like compete against each other?
And there's like Code for Arena.
Yeah, Code Arena. That's super interesting. It's like you get a bunch of auditors in one room. They all compete against each other. I actually saw a quote yesterday of someone at an ECC event saying, oh, Code Arena's not great. Well, the quote came from someone who owns an auditing company. So, I mean, obviously subjective, but so like, for example, Index Coop would hire like Code Arena. We'd also hire a traditional audit firm. But you really have to like get deep into the code, and if you're just sort of putting the hand wave over and saying, oh, this is probably good because Compound V1 was good, Compound V2 is probably going to be fine as well, that's not a good way to go about this. So like I said, when you have a team like Aave getting 6 different independent audits on their Aave V3, like that's what all these teams should be striving for. And it's not cheap. I think we spent like $150,000 on 2 audits we had a couple months ago, but that's one of the main risks when it comes to building these DeFi protocols. And if you're not like really serious about audits as well as bug bounties, you're going to be in trouble. So ImmuneFi is a good example of a bug bounty platform. Basically what you do is you say, all right, here's $10,000. If someone finds a medium severity risk, you're going to get that $10,000. So it's you're sort of incentivizing white hat hackers. We've seen plenty of examples of people coming in and exploiting a DeFi protocol and not being able to get anything out of it, or they try to put it through Tornado Cash, RIP. But like, you could try to exploit one of these protocols, but you're not really gonna be able to do much. So what ImmuneFi does is that they give rewards to people who try to come in and fix some of these problems. They'll let the team know, and then you can go in and patch it. But yeah, I hope there are more programs like this. I would recommend all DeFi platforms to have something like this, because it can have a huge impact on like long-term safety. So I used to work in insurance before I worked in equity capital markets. Insurance and crypto is certainly the most underdeveloped sector, in my opinion, within DeFi. Nexus Mutual, I'm a huge fan. We've built some of our risk frameworks on top of what they built. It's actually the first thing in DeFi I looked at was how does Nexus Mutual like evaluate some of the risk of these protocols. Nexus Mutual just launched their V2, which is a bit more broad-based, but generally like there's 4 names here. There should be 50 names here, right? I mean, if you actually look at the percentage of DeFi that is insured, it's probably so much lower than you could even guess. Nexus Mutual is relatively big for DeFi insurance, but it's not 100% of DeFi TVL, and it should be closer to that. And hopefully, as we have more and more sophisticated actors, more institutional actors come into this space, they're really going to demand insurance. And if you don't have that ready for them, you're going to be in a lot of trouble. So I have some DeFi positions. I get cover for them on Nexus Mutual. Nexus Mutual only covers smart contract exploits with their V1. Their V2 is a bit more broad. But yeah, this needs to be looked at much deeper. If I were an investor in the crypto space, I would say insurance is where I'd put my money, just because if you look at traditional world, like they're gonna insure every single one of their products. And if they don't have insurance, they're gonna think something's wrong with that. So I'd recommend others to look at a few of these. Sherlock is a great example of like starting at the root of the problem. Sherlock also is an auditing firm, so they give insurance to the protocols they audit. I think that's incredibly novel. It's actually very cool. But like sort of starting at the root of the problem, like I said, of okay, what's the risk? Smart contracts. We need to have the best smart contract auditors, and then we can underwrite the risk of this protocol. But yeah, I'm a big fan of Nexus Mutual. I'm a big fan of all these on this list. I hope there are more providers. If anyone's thinking about building a protocol, let us know. We'd love to incorporate it in some of our products. But yeah, like I said, it's certainly the most underdeveloped part of the DeFi space.
Yeah, and I think insurance I think will be a big thing in DeFi as well, especially when unlike TradFi where there's legal recourse, protocols are going to be seen more like infrastructure rather than kind of companies, where if they get a hack, you're not going to be able to like take them to court or anything like that. And so as they're seen more like infrastructure, it will be more like insurance as a backup if things go wrong. So I think it's definitely a huge space. And of course, kind of insurance sounds kind of boring, but for some of us, we see it with a bit more excitement because it also means that there's risk there, and that means that there's also potential sources of yield. So in the future, these might be sources of yield for products, as well as obviously covering protocols.
Do you want the meet prop? It's okay for discussion.
Yeah, would love to hear about it after. So what Nexus Mutual is trying to do with their V2 is sort of open up this space and allow risk managers to come in and give a view of what this potential risk could look like. But I totally agree. And I mean, when we talk about like the cool parts of DeFi and crypto, many of them are like about automation. If you can automate the insurance claims process, that would totally revolutionize some of what we're looking at here.
Thank you. Do you guys have any questions?
Well, do you mind if we do that at the end?
Oh, sorry.
Do you mind if we do that at the end?
Oh yeah.
Cool.
Sorry.
A couple more slides. So this is an important one to me. When you try to get into like a money market protocol, for example, they're gonna be like, all right, do you have an oracle? Do you have multiple oracles? Paul can talk about this as well. But these are some of the requirements Chainlink has. 2 million average trading volume. You'd be surprised there are not many tokens in DeFi that have 2 million average daily trading volume and true trading volume, so not a bunch of bots trading against each other. So you'd be surprised there aren't many that have this. There are a lot of protocols coming out recently. Andrew can talk about a few of them, but that are oracle-less. Don't ask me how that works, but oracles are a huge part of DeFi. Basically, every protocol is reliant on Chainlink. To me, that's an incredibly huge risk that there's really only one provider doing this. So like I said, if you're building an insurance protocol, great job. If you're building an oracle provider, great job. We need more of all of those. But yeah, those are some of the requirements. It's tough to get products that have truly good oracles. If you don't have a good oracle, what you can do is get like a Uniswap TWAP price, and that can be manipulated. It's not ideal, so the Chainlink requirements are very fair. But again, when you have protocols that are completely reliant on one provider, that doesn't sound very decentralized to me, and it's certainly a risk factor. Okay, so we went through some of like how we rate these things. You can agree or disagree with these ratings, but this is sort of how we came up with some of these things. I try to make it a little bigger if I could. But basically, we went through all of those areas, and we put this on different assets. So you could say on this list that something like USDC is maybe riskier than Binance USD. That's a pretty high score from Binance USD, but I tend to agree. And then as well as LSTs, liquid staking tokens. Those are some of the risk ratings there. For example, we use staked ETH in some of our products. We don't use something like Coinbase ETH in some of our products, for example. But these are generally how we score some of these. They could be right or wrong, but unless we're able to actually put some numbers on these, it's difficult for us to give actual ratings. These are ratings on some protocols we build on top of. This is all like open source, so you can take a picture or we can send it to you guys. It's on our forum, gov.indexcoop.com. But this is how we think about all these protocols. And if you don't go through each one of these and say this is how I rate this protocol, you again could be left in the dust. So this is how we think about it. We could be right or wrong on these, but this is how we sort of start once we build some of these products. This is how we rate one of our products. So we take what we just did with the protocols and assets we're using, and then we come up with a absolute risk score and a relative risk score. So you could say we have some ETH yield products that, from the outside looking in, like for a user that doesn't know anything about DeFi, they go, ETH, oh my God, that's very volatile, it's very risky. To us, if you're comparing apples to oranges, there's no point. If you're comparing ETH USD, like obviously ETH's riskier, but if you're comparing an ETH product to another ETH product, how do you actually weigh those? So that's why we came up with relative risk scores. And again, it's using all of those risk factors we've talked about before and sort of trying to put some numbers on top of it. Here's some examples, some other risk frameworks. I don't know if anybody's in the Society of Actuaries, but if you don't start the insurance level and try to underwrite risk from there, you're going to be in a tough spot. RiskDAO is a super interesting team. They've come up with some really good dashboards, as well as generally like some dashboards that have like bad debt within the ecosystem. Again, Nexus Mutual, as I mentioned, is there, as well as Moody's. They've actually done some risk assessments in DeFi, which have been very valuable. So I'd recommend reading those. They definitely look at it from a different lens, which I think is incredibly important. So these are some of the risk frameworks that Gauntlet has put together. So I'm going to invite Paul up to the stage. If we can get him a chair.
Cool. Thanks for having us, David and Andrew. I'm Paul. I'm the protocol lead at Gauntlet. How much time do we have, by the way? 5 minutes? All right, we'll be quick then.
3 minutes.
All right, cool. We'll be super quick. One of the solutions we provide is risk management to DeFi protocols. So our clients include Aave and Compound. At a high level, we focus on something called market risk. We kind of talked about a variety of different kind of risk factors. When we are talking about market risk, we're generally talking about the balance sheet exposure that lending protocols or CDPs or perps have. Basically, any protocol that enables leverage for their users, they take on a certain level of balance sheet risk. And essentially, we're trying to quantify the amount of bad debt or insolvencies these protocols can face in an adverse market shock. Basically this is separate from smart contract risk in the sense that we assume the contracts are working correctly as intended, but now what is the risk if there's a broad market downturn? Part of that involves running a ton of agent-based simulations to predict areas like depositor and a borrower and liquidator behavior to predict that, hey, if liquidity dries up, if there's a depeg, et cetera, will liquidations be profitable? Will the liquidation mechanism fail? Will adverse liquidations happen? And then quantifying actually how much these protocols will lose in an adverse market shock. This is like I guess one of the dashboards we have. We have dashboards for all of our clients, and essentially it provides transparency into certain metrics that are related to market risk. Those metrics include non-protocol specific metrics such as in assets liquidity, assets volatility, the correlation the assets have with each other, et cetera. And it also includes protocol-specific metrics. For example, how concentrated is this market? What is the amount of supply on the market relative to circulating liquidity? Is the supply concentrated by a few users? What is the health factor of those positions? Something interesting to note is that economic risk actually has resulted in more notional dollar losses by protocols and smart contract risk. However, this is not very widely known because a lot of the so-called Oracle manipulations have been misclassified is not the problem of the Oracle, it's actually a problem of price manipulation. The Oracle is given the right price feed, it's just the price is manipulated by actors. So part of the challenge is quantifying the risk. Hey, like how much does it cost to manipulate this asset's price? And that depends on the liquidity, it depends on how many venues it's traded on, depends on market maker behavior and fading away price manipulation. Yeah, I guess that's an additional thing that Gauntlet looks at. And so we have research if you're interested in learning more about the risk methodologies and simulations, and then we have these dashboards. And as a part of our work, we get to work with great delegates like Index Coop who take a very data-driven approach to making governance decisions.
Yeah, certainly. Thank you, Paul. We're about to wrap up here. I was hoping to ask him more questions. Generally, when we look at this, like there needs to be more quantitative analysis. There need to be simulations run like the Gauntlet team does. I'd recommend, not going to shill them, but hire a risk management team if you don't have one natively on your team. But yeah, that's about it. You can find us here. Again, I'm Funkmaster Flex, David Garfunkel, Andrew. We're Index Cooperative and Gauntlet. Thank you, guys.
Thank you, guys. Thank you, guys. So feel free to ask the speaker if you have any question, but outside because the next conference is going to start in a few minutes. Thank you.
Anybody want a shirt? Let me know.
Merci beaucoup.